Thanks for joining or rejoining us today. My name is Ashlyn Lovett, and I'm the Assistant Director of Events and Volunteer Management for Grand Valley Alumni Relations. Through our partnership with Consumers Credit Union, we have invited you to join us for lunch as we dive deeper into a variety of key financial topics. Over this 8-week series, we take a deeper dive together as we learn about identity theft, mortgages, credit reports and scores, and today's presentation considering home ownership. Before I introduce our presenters, I do have just a couple Zoom keeping notes. This presentation will be recorded and will be accessible on our Alumni Career and Life Stage Resource Library. I'll share that in the chat shortly. Please feel free to use the question feature to submit questions. And at the end of each section, our presenters will take questions. We'll also interrupt for questions during the presentation and then allow some time at the end for questions. So plenty of opportunities to ask what you'd like to know. Our program will wrap up right before 1 p.m. With that, I'd like to thank our friends at Consumers Credit Union for partnering with us today to bring this series. Today's program is led by two GVSU alumni presenters, Gregg and Rustin. Gregg, thank you so much for being here today, and Rustin, you too.
Thanks for having us.
Thanks for having us.
And Gregg is going to kick us off.
Hey everyone, my name is Gregg Teegardin. I'm a residential mortgage manager and lender at Consumers Credit Union. I've been in mortgage lending since I graduated from Grand Valley State University with a degree in finance in 2001. So gives you kind of an idea of my age there. My first job in mortgages was working for another GVSU alumni's mortgage company. He connected with me through my career counselor at GVSU. So if you are a student, definitely use that resource. It's been a great fit for me and very passionate about what I do. My co-presenter today is Rustin Scott. As Ashley mentioned, he's a GVSU alumni as well and a top realtor at 5 Star Real Estate. So getting into the presentation, I do have quite a bit of material to cover here. It's more of probably a half a day's worth of information. So I'm gonna do my best to burn through it in about 30 minutes here, so bear with me. So first, just getting into the workshop goals. Today, we're gonna get into discussing homeownership, the home buying process, and how to prepare yourself for owning a home. If you do have any questions during my presentation at any time, please use the raise hand react button, and I'll do my best to answer in the moment or at the end of the presentation. Buying a home involves some major decisions, which can be both exciting and a bit intimidating. This workshop is designed to help familiarize you with the home buying process. You'll learn how to prepare for a mortgage, understand the terms of a loan, review the one-time and ongoing costs associated with home ownership, and explore methods to build your personal and financial readiness for home ownership. Rustin and I work with many home buyers every day, and our goal today is to share our knowledge and experience with you on why you should consider purchasing a home if you haven't already. Let's begin with an overview of the topics we'll cover today. Starting off workshop goals, we're going to cover some important information to help you prepare for home ownership, such as how lenders evaluate your loan application, steps you can take to prepare for obtaining a loan, and costs you'll encounter on your journey towards home ownership. Specifically, we'll explore the following: the costs and responsibilities associated with home ownership, the loan and repayment process, and how to find out if you're financially ready to own a home yet or not at this time, and how to get prepared to be. By the time we complete this course, you should have a better understanding of how to begin working towards home ownership. Many people are unclear about the benefits and challenges associated with owning a home. Let's take a minute to review some of these. So going through some of the pros and cons, it's important to understand what's involved. What are the benefits of home ownership? Are there any negatives? First pro is your home an asset? The value of a house can go up over time as a pro. A con is the value of a home can go down over time. In general, home is considered an appreciating asset, meaning its value increases over time. However, it's important to understand that real estate values can fluctuate both upward and downward depending on the market. There's no guarantee that you'll eventually sell your home for more than you paid for it. For instance, if you have to move for work or other reasons and you're forced to sell when prices are low, you may end up losing money on the sale. With this said, the National Association of Realtors reported that the average annual appreciation rate for US real estate is around 4% the past 10 years. This means, just an example, if you purchase a house, say 10 years ago for $200,000, it would be worth $296,000 today. It's a pretty healthy gain there. Next, pro and con, you need to make payments towards a home. The pro is a portion of every payment, monthly payment on a mortgage goes towards the principal, which is the amount you borrowed from the lender, and gets you closer to owning a valuable asset and building equity. The con is you generally need to make a down payment upfront when purchasing a home. You have monthly payments and other one-time and ongoing home ownership costs. So you do need a steady and consistent income and savings ultimately to purchase a house. Buying a home is a forced savings plan. In the end, you will own the house. Even if the value were to go down, you'd be better off than if you remained a tenant, since you're likely to have equity in the home to show for payments that you made on it when you own, as opposed to renting and paying somebody else's mortgage for them. One thing to note here on payments on a mortgage is that you do not ever want to get a month behind on a mortgage payment. This is a huge hit to credit scores. I've seen one mortgage late drop credit scores of a borrower more than 50 points, which can drastically affect your interest rate. We'll dive into credit a little bit more later here in the presentation. The next pro and con, you need to pay taxes on a home. The pro to that is homeowners may be able to deduct mortgage interest and property taxes on their income tax return. The con is you have to pay property taxes, which you wouldn't be responsible for as a renter. I do want to mention here that property taxes will go up when a home is purchased, since the home will be reassessed by the assessor with the change in ownership. The average increase we have found is 35%. So when you go to buy a house from the current homeowners, the taxable values are generally pretty low because they're grandfathered into a lower tax rate. So I always prepare my buyers that, the taxes initially are going to be lower with your monthly payment, but they're going to go up, and so the people that I'm closing this year, next year, 2025, the place is going to get reassessed, and their summer and their winter tax bill is going to go up roughly 35%. So just an idea on that, if you have a home with $3,000 in taxes currently, it's likely they're going to go up about $1,000 the following year. So I just like to have my buyers plan for that with their budgets, so they're not unpleasantly surprised later in the process. Lastly, what are the pros and cons of the idea that you can remodel your home any way you like it? When you own a home, you can renovate it and decorate it how you want and don't have to get the approval from a landlord like you would when renting. You also gain the equity in the home from any updates that you do to it. The con is you're responsible for all repair and maintenance costs that the landlord would be responsible for if you're renting. Owning a home means that you're the boss. You can decide to paint or remodel as you please, but you're also the one who has to pay the plumber when you have a faulty faucet. Knowing the pros and cons of home buying gives you a realistic approach towards home ownership. Now let's talk about what you can do to prepare yourself for the process of buying a home. Some common terms we're going to go over here are income. Starting off with income, this is money earned from employment, fixed income, or investments. Diving into it further, it's important to know that if you are considered self-employed, then you generally have to wait to have a full 2 years of being self-employed in your tax returns for us to use that for qualifying you for a mortgage. So keep that in mind. If you're thinking of starting your own business, you're generally going to need 2 years on your tax returns of that income to show consistency. If you're W-2'd, we only have to show 30 days of paychecks. So if you're W-2'd with an employer, getting tax ticket on each paycheck, and you're salaried, full-time, or hourly, then we would just need 30 days of paychecks. So it's a little easier to qualify for a mortgage if you're W-2 than if you're self-employed. In 1099, something to note here, 1099. So if you're a realtor such as Rustin or a contractor, you're generally going to be 1099, which is considered self-employed as well. And that falls into the same guideline where we have to have 2 years. Sometimes we can do it with just 1 year of tax returns if somebody's putting down a substantial amount of money, but it does make it a lot more difficult to get qualified from an income standpoint if you don't have the full 2 years. So definitely something to think of when you're going to purchase a house. So income history, getting into that next, this is proof of current and previous employment. As I mentioned in the income section, we do need a 2-year employment history for buyers when they apply for a mortgage. It is okay if you're a recent college graduate and don't have a full 2-year history yet. We just need your school transcript, to show that you're working in the line of work that your degree is in. We can build a 2-year history off that. So if you're just getting a job out of college and you have a contract, that's fine. The start period, if you haven't started your new job yet out of college, then we just have to have a start date that's 90 days out from our closing date. So you don't necessarily have to have a month of work yet. If you do have a contract in hand, we can go off of that and use the salary. One big thing to note though is if you're taking time off in between jobs and there's substantial job gaps in your income history, that can cause some difficulties in getting qualified as well. We like to see consistency there. So try not to have 2-3 months off in between jobs if you're switching up. Debt to income ratio. This is a percentage that measures how much of a person's gross monthly income goes towards debt payments on a buyer's credit report. Debts include the payment on the proposed mortgage, including property taxes and insurance broken down monthly, car payments, student loans. So even if your student loans are deferred, we still do have to use a formula that Freddie Mac and Fannie Mae require us to use to come up with a payment for that. It's usually 0.5% of what your total balance is on your student loans. So keep that in mind. If they're deferred, it doesn't mean it doesn't count into your debt to income ratio calculation when you're going for a mortgage. Utility bills don't get counted when you go for a mortgage for qualifying. So that's one benefit there. So your gas bills, your trash, your cell phone, those don't get counted in your car insurance, things like that. It's only things that are on your credit report that we have to count into your debt ratio. The max debt to income ratio allowed to qualify for a mortgage can range from 45 to 50%. So an example, if you make $6,000 gross per month, we can go, just to note, we can go off your gross monthly income. It's not after taxes. So if you're salaried at $72,000 divided by 12, we have $6,000 per month that we can use for your income. The max that you could be on that and qualify for a mortgage with your debts, including the new mortgage payment, is $3,000 per month. I don't recommend going to the 45, 50%, because if you do that, you're going to have a tough time outside of making your mortgage payments, having a life outside of your house. I try to keep my buyers closer to 30 to 35%. So that's definitely a number that I would look more towards hitting, is that 30 to 35%. And we'll go over a calculation later on how to figure this out with your income that you currently have or that you're expecting. Credit score. This is a 3-digit numerical score that predicts a person's ability to repay loans and can range anywhere from 300 to 850. I've never seen somebody below a 500 credit score. So it usually ranges more so between 500 and 800. I've also never seen somebody with an 850 score. So most borrowers have a 700 plus score if they haven't had any lates, 30-day lates on their credit in the last 12 months. Usually they'll be in that low to mid 700 range. There are 3 repositories used for scoring, which are TransUnion, Experian, and Equifax. And the middle score of these 3 is what's used to qualify you for a mortgage. So keep that in mind. It's not, when you go for an auto loan, usually they're just going to pull, or we're going to pull your TransUnion score to use to qualify you, only one score. But for mortgages, there's all 3 of them are pulled to TransUnion, Experian, and Equifax, and we use the middle of the 3. So it's not a weighted average, it's just the middle of the 3. There are different credit score requirements for loan programs available to home buyers. To get the best rates and loan products, you do want to have that 700 score, which I mentioned, which most people do. FHA, if you've heard of FHA, and it's really geared towards buyers that have a lower credit score. The beauty of it is they'll allow you to just put 3.5% down, and you can have a score as low as 600 with FHA. So if your scores are lower, there are other options other than conventional with Freddie Mac and Fannie Mae. They do require a 680 on conventional loans, but FHA will let you go all the way down to 600. You do pay for it, which I'll get into more in the next webinar, which is for mortgages. You do pay for it with your PMI insurance, and they do have a sizable upfront fee that you have to pay for FHA, but it allows you to get into a home with a lower credit score. So just something to keep in mind as an option. Last term is the down payment. Down payment's a lump sum of cash used to pay for part of the home that shows lenders you're committed to purchase. This can be as little as zero down going VA for veterans, or we do have some zero down products available at consumers as well that's unique to us for lending. So if you have a 700 credit score and a full-time job and your debt ratio is in line, we can do zero down at consumers for you as well. VA, just like FHA, the governmental loans, they'll go all the way down to a 600 score and do zero down for vets. Down payment funds need to be in a borrower's checking, savings, or investment accounts, such as a 401k plan. It can also be a gift from family. So I do have a lot of college graduates that I work with, first-time home buyers, that their parents, have 10, 15,000 or so to gift them after college for a down payment. So if that's a possibility for you, we do allow that for the down payment requirement. Any large deposits, something to keep in mind too. If you have some large deposits going into your accounts, we do have to document and source it. So it can't be a loan. It would either have to be a gift, but we do have to source anything done in the last 60 days. Your ability to save money also shows lenders that you're capable of maintaining a safety net in case of an emergency or unforeseen circumstance. Top 3 reasons people default on loans are due to family-related changes, for example, new baby, suddenly having to care for an elder, causing your expenses to increase. Secondly, an accident that requires medical attention or time off work can cause issues. A change in job status that causes income to decrease. So just some things to keep in mind when you're going into a mortgage. That's why I definitely recommend keeping a safety net reserves in your bank account over and above the down payment and what you put down on a home. If you can keep 3 to 6 months of your mortgage payment plus any other debts in your credit report and savings, that's ideal just for a rainy day fund. Lenders,
Sorry, we did have a question pop in here that I'd like to address. It says, if you've signed a contract but haven't started working yet, do lenders take that into account?
Yeah, so as long as it's within your start date is within 90 days of when we close, then we can use that contract. So it does have to be a full-time. It can't be a part-time position. It has to be a full-time salaried position, or it can be 40 hours a week. And as long as there's a 40 hours on there along with the hourly wage, we can use that. If you're in, I know with nursing, if you have anybody that's in nursing, going to be an RN, that's typically full-time is considered anywhere from 32 to 36 hours, which we're aware of, so we can use that for RNs.
Thank you.
Yeah. So jumping back into the terms, some lenders prefer candidates who are low risk, meaning those who are well prepared to pay their mortgages, even if their present circumstances changes. So our underwriters are looking into the overall picture of the debts and the history to make sure you're a good risk to lend the money to. A major concern for lenders is typically, can you repay your loan? So borrowers who have a steady income, savings, a good credit score, and a good debt to income ratio are typically considered low risk and more likely to pay their mortgage on time. On the other hand, a person with insufficient income, little savings, poor credit, or high debt to income ratio is viewed as more likely to default on a loan and considered a higher risk. So jumping into the next slide here, the 5 C's of credit. For any type of loan, lenders usually use 5 criteria to determine your credit worthiness, also known as the 5 C's of credit.
Greg, there was a couple more. Sorry to interrupt. There's a couple more questions that came through.
Yep.
Thanks, Rustin. Can you briefly explain Michigan's first-time home buying programs and what makes you ineligible to capitalize on this opportunity?
Those I'm going to be covering in, because that's going to be pretty expansive to go through that. It generally, you have to be within a certain median income in the county that you're buying in. So I'll dive into that more in the next webinar. But to be a first-time home buyer, just real quick, you have to have not owned a house in the last 3 years. But some of those products, they are restrictive depending on what your income is.
Thank you. And our next question that popped in was, so you have to have been employed full-time for 2 years to be considered for a loan, or are there exceptions for jobs up to 40 hours?
You don't, so the 2 years income is just if you're self-employed. So if you started your own business and you're not working for somebody else and you're not W-2'd, then you have to have 2 years history. But if you have a job where you're getting 40 hours a week, you're W-2'd full time, and your employment history was either you were in college prior or you had another job and you just started a new one, that's totally fine. You don't have to have 2 years. It could be just 30 days in a job, and we're fine with that. It's only when you're self-employed or when you're 1099, you're not getting tax taken out of your paychecks.
Thanks for clarifying.
Yeah. So jumping back into the 5 C's here, first one, capacity. That's your ability to pay your bills now and in the future. If you have a steady job or profitable business, lenders will trust that you'll be able to pay your bills. You need to be below the debt to income thresholds mentioned before, and you can't have, as I mentioned, a bunch of large gaps in employment. And we do still need that 2 year, we need to show a 2 year history, but if you have a new job or if you're getting your first job out of college, that's fine. We just still need to have a 2 year history of either schooling or employment. Next C is capital. This is readily available money and savings, investments, properties, and other assets that you could sell fairly quickly for cash to pay back a loan. Next is collateral. This is property or other possessions of value that you can put up as security against your loan. This is the subject property when doing a mortgage for a financial institution. Character is your history of delivering on commitments. If you pay your bills on time, you'll be considered a low-risk borrower. You can't have any over 30-day lates on a mortgage or any over 30-day lates in rent in the last 12 months of pay history to be able to qualify for a mortgage. The only time I've ever been able to get somebody approved that's had lates on a mortgage is if they put down 30 to 40%. You're talking a substantial chunk of money that you're having to put down if you have a late on your mortgage. If you're doing anything less than 20% down, you can't have a mortgage late or a rental late. So make sure if your name's not on a lease, we still need to show, if you're renting, say, an apartment with a bunch of friends or family, your name's not on the lease, we still do need to show a 12-month history, a payment history, either through rent or previous mortgage. So the only time that lates report to the credit bureaus that I mentioned is if you're 30 days late. So if you're 15 days late, you may get a late charge on a mortgage or a car loan, but it's not until you're actually past 30 days late that it reports, and that's when it hits your credit score. So just keep that in mind.
We did have a question come in the chat here. I'll ask it, and you can address it how you'd like, but it might be a personal question that we will want to get the information for this person and have a direct follow-up. Regardless, they asked, I have been on and off work since COVID with various W-2 and 1099 positions. I have $120,000 in student debt, but my credit score is 780. My husband has a stable income on a W-2 for 10 years and will soon have no debt. How do you take this into account considering both of our financial situations?
So that'd probably be best, answered in an email, breaking that down, because I'd want to get more in depth on the income for both. But we don't have to use both borrowers' income to qualify. So I don't know in this situation if the individual, her husband is, you said W-2'd, correct? But she's not, she is as well.
It sounds like he's been consistently W-2'd and she's bounced between, having W-2s and 1099s.
Yeah, so if she's currently 1099 and hasn't been, for 2 years, then we couldn't use her income. So we would keep her off the mortgage. She could be on the title to the home and we do the mortgage just in the husband's name since he has the consistent income that we can use. If she's currently W-2'd and full-time, then we can use that income and have her on the loan. And there's also credit scores that she brought up. So I always look at the whole picture. We'll pull both borrowers' credit to start, but if one borrower's credit is less than the other ones, it does go off the lower of the two borrowers' credit scores when you go for a mortgage. So that affects your interest rate and what the down payment requirement is. So if the borrower with the higher credit can support the mortgage on their own and it gives them enough money to purchase the house that they want to buy, then I'll do the mortgage just in the one individual's name with the higher credit.
Thank you.
Yep. So I believe I was on the last C here, which is conditions. Conditions, which are the general circumstances of the borrower and the loan, such as the purpose of the loan, factors that might affect their ability to repay, and similar conditions that might impact the loan in general. This generally comes down to character and what your credit score is and your last 12-month payment history has been on your existing debts. If you don't have much of a credit history, lenders may feel more comfortable giving you a loan if you have collateral to secure it. So it's actually easier to get a mortgage and a car loan than a personal loan if you don't have a lot of credit, just because you'll have the car or the home as collateral for that. For a mortgage, and I'll get into this in the next webinar more, we do like to see that you have at least 3 trade lines on your credit with a 12-month history. So just keep that in mind if you don't have, I don't like to be an advocate for credit cards, but if you don't have anything on your credit, and then it might be a good idea to open some line of credit up. Just make sure you keep that at 30% of the available limit on credit cards.
Greg, can you speak a little bit more to what trade lines are?
Trade lines would be anything like a car loan, an installment loan, a credit card, or something, a credit card from a department store. At Consumers, we do offer a prepaid credit card where you can, if you don't want to necessarily have a MasterCard or Visa, we can get you a credit card with Consumers where you essentially fund the card yourself, but we report it to the bureaus for you as a trade line. But we like to see 3 trade lines. FHA will allow you to have non-traditional trade lines where we can use your utility bills to build a credit history, but only FHA would do that. With Freddie Mac and Fannie Mae, they like to see the trade lines be on your credit report.
Thanks.
So now that you have a basic understanding of some of the important terms and how your assets play a role, let's discuss how you can assess if you're ready to buy a home. To prepare for homeownership, you'll want to develop an awareness of your financial situation by making a list of your assets and debts. You can easily do a rough estimate of home prices you should consider. One method that I find is if you can multiply your annual income by 2 or 3, that's a good indication of where you should be on a home purchase price. Another way to estimate it is by calculating your monthly gross household income, which is your income before taxes, and looking for homes that will have monthly housing costs that are no more than 30 to 35% of your gross monthly income. I'll show an example of this on the next slide here. Just one second. So getting to the next slide, I have an example with Rory here. This just gives an idea of between renting and owning comparison in the greater Grand Rapids area for a potential first-time home buyer. This is a good example to see how the debt-to-income ratio is calculated in qualifying for a mortgage. So you can see the rent scenario is about $500 less per month, and I use the average for a 1-bedroom, 1-bath, and it's actually when I ran it, it was a 900 square foot apartment. The average rent in Grand Rapids, greater Grand Rapids areas, is $1,500 a month. For a $250,000 mortgage, which is 3% down, with taxes and insurance included in PMI, the payment came in at $2,000 a month. So it's $500 more for the averages for an average home compared to average rent. But the benefit obviously is you own the home and you're building equity and you have an investment there. You also, if you have roommates or plan on having roommates, and you can collect rent from them on your house and have them help contribute towards your mortgage to help build equity for you. So the debt to income ratio I wanted to get into here. This is using the slide before this from Rory. So Rory's at 72,000 a year, income of 6,000 gross monthly income, and the debts that were on there for the mortgage were 2,600. That was the car loan, the credit card payment, the student loans, and the mortgage. That all added up to 2,600. So when you divide that 2,600 into 6,000, Rory's DTI is 43% in that scenario. And as I mentioned before, 45% is kind of that threshold where you want to stay. You can sometimes get exceptions up to 50%. I really like to see 30 to 35%, ideally, unless you're expecting, a substantial raise in the next couple months. I really like to keep that more around 30 to 35% if possible, just so you have a life outside of your home. So if you do have a pen and piece of paper handy with you, let's go ahead and just do a quick rundown on your debt to income ratio. If you can total up what you're paying monthly on your student loans. If you don't know what your payments are on your student loans because they're deferred, then take the balances and multiply that by 0.5%. And then if you have an auto loan payment, add that in, any installment loans, any credit card payments monthly. If you add all that up, utility bills aren't counted in this, so don't add in your utility bills, just what would be on your credit report. So again, installment loans, credit cards, student loans, and auto loan. Now take that number and divide that into your gross monthly income. So if you're hourly, you'll want to take your hourly wage times 40 hours times 52 divided by 12. That'll be your gross monthly income. Or if you're salaried, divide that by 12 months and divide your debt load into that. So that's your current DTI, debt to income ratio, before you go for a mortgage. So now if you take your gross monthly income and multiply it by 45%, since that's generally the cutoff that you can go up to qualify for a mortgage, so if you take your gross monthly income, multiply it by that 45%, now subtract your total current monthly debts from that. Again, not including your utility bills or your rent. So what's left there for that number, that's what you could allocate towards a mortgage payment each month. Just a quick rundown of how that works.
As folks are working on this formula, can you clarify how this works when you're buying a home with your partner? Do you combine incomes and use 30% of that?
Correct. Yeah. Yes, you would combine your gross monthly incomes, your household income. You don't have to be married it's just if you're buying a house together, your partner, then we could use both incomes.
Another question that came in is, when considering debt to income, will lenders consider the timeline of the debt? For instance, if a loan is projected to be paid off in 10 months, is that considered?
Sorry, can you repeat that, Ashlyn?
Yep. When considering debt to income, will lenders consider the timeline of the debt? For example, if a loan is projected to be paid off in 10 months, is that considered?
That's a great question. So installment loans, if you have an installment loan, let's say you have a car payment and the balance is $3,000 on that, and it has a monthly payment of $300, as long as it's under 10 payments left, then we can exclude that from your debt to income ratio in that scenario. So if you have a $300 payment, if the balance is $3,000 or less, then we can exclude that. It does have to be a car that you're purchasing. So an example on a car, if it's a lease, then we still have to count it, because you're going to obviously, once the lease is up, get another lease. But if it's one that you're buying, we can exclude that. So, and then for any personal loans that have terms on them, as long as they're less than 10 months, we can exclude it. But revolving debt, like a credit card, that can go on forever, depending, because those payments fluctuate. So those are always going to get counted in to your debt ratio, unless you pay it down to a zero balance. So I do have some borrowers that will pay their credit cards down to a zero balance, and we can, before we close, to give them more purchasing power, and we can exclude the credit cards at that point from their debt ratio. They pay them down. So just because we pull credit and you have balances on your credit cards doesn't mean you can't still pay those down and we'll get it updated on our end and pull that out of your debt to income ratio. So then you can have more buying power.
Thanks, Greg. We did have 2 more questions come in. I'm just wondering how you're doing on time, if you'd like to answer those now or continue and see if we have time at the end.
Yeah, I want to leave Rustin about 10 minutes here, so I could take maybe another question, and then I should move on just to make sure we cover everything.
Okay, let's go ahead and do that. And then any questions we don't get to today, we'll make sure that there's personal follow-up so you can get those answered.
Yeah, my email address will be at the end, so please feel free to email me any questions you have.
Thank you. So someone asked, why is gross monthly income used for DTI? Curious, as many have significant amount of their income taken out in federal, state taxes, 401k, and health coverage costs taken from gross pay.
I totally agree with you. That's just the way Fannie Mae, Freddie Mac, and all the outlets, governmental loans, that's just how they've always calculated it. That's why, I don't think you should push, 50% of your gross monthly income, even though it's still allowed. I was lending in 2008 when we had the housing crisis, and the majority of those loans were people that get, in over their heads. And when values dropped, they were the ones that, did 50% in their debt ratio, and they couldn't afford to keep their mortgages anymore if they had any change of circumstance, or if they were in an adjustable rate mortgage where the rate went up and the payment went up a little bit, they couldn't afford it. So if you stay in that 30 to 35% of your gross monthly income, that you're going to be in a good spot, moving forward.
Thank you.
But yeah, it is off your gross. And that's just the way, for lack of a better explanation, that's just the way it's always been calculated since I got into mortgages. But that's also why, like I said, I like to keep my buyers at that 30 to 35. So just moving on, in general, the lower your DTI, the better your balance between debt and income, and the more you're likely to get approved for the loan. Borrowers with high DTI percentages may have more trouble making payments. If you find yourself with a DTI, debt to income ratio above 45%, what are some ways you can improve or lower that number, which we went over a little bit, by paying down credit cards, reducing spending on non-necessities to avoid taking on additional debt, and then looking for a job with more income to lower your ratios overall. So we've touched on credit scores quite a bit already, so I won't spend a lot of time on this slide here, but your credit score reflects how responsibly you've paid your bills and debts in the past. It plays a major role in your ability to obtain financing, probably more so than any other factor. We already talked about, like I said, a lot of the 3 systems that are out there, the 3 bureaus, and that we use the middle of the 3 scores. When you do apply for a mortgage, be prepared that your lender is going to ask you for your social security number and date of birth. We can't pull credit without that. So there's no way for a lender to pull your credit until you give them that social number. So make sure you're ready to get formally pre-approved when you offer that. It is possible, if you have an idea of what your credit score is, if you have a ballpark, for a lender to give you an estimate without having to pull your credit. So a lot of times, I'll work with buyers and not pull their credit, but I'll get their income. And if they know what their credit score is or an idea of it, then I'll run a scenario for them before we go ahead and pull credit to make sure they're ready to buy. The credit report will show your history of debts and repayment for bills such as credit cards, student loans, and car loans. This report will also include a score based on your history, which are the 3 scores that I mentioned. Credit scores impact your interest rate more so than any other factor as well. So a 780 plus credit score is where you're going to see the best interest rates available with Freddie Mac and Fannie Mae with the conventional loans. If you want to know a place to get a free credit report, please go ahead and email me after the presentation. I'll send you a link if you're not sure what your credit looks like, because I know there are some free credit report options out there. A lot of times it only gives you 1 score. So if you want a link to the bureaus, go ahead and email me and I'll send it over to you to see and have a better idea of where you're at. because it is very important to know where your credit score is so you can work on improving it. There are ways to get your scores up. So we do have a credit expert system at Consumers where if somebody's credit is lower, if it's under 700, then we can look at what they can do to boost it and get them back in the 700s. So keep that in mind too. There are ways to boost your credit up quickly. And then just some quick tips that might help you improve your score. I did mention earlier, if you take credit cards out, make sure you keep those at 30% of the available credit. Don't max those out because it does bring your scores down when you have multiple credit cards the balances are close to the limits. Make sure you pay your bills on time, and then just make sure you check your credit occasionally so you know where your score is at, and that's something to go on there that shouldn't be on there. And then we'll get into the cost here. I'm going to do my best to breeze through this. I want to get Rustin on in the next 5 minutes here. So understanding the home buying costs with home buying can help you be better prepared to make all the necessary payments responsibly. Some of the common costs that you'll see are the down payment, miscellaneous costs, and closing costs. This is just a scenario here to show you this is just the interest cost of a loan, but gives you an idea of why a down payment is really beneficial. If you do zero down on a loan, which we can do at Consumers, it does have a higher interest rate because it's more risk that we're taking, obviously doing zero down. We don't have PMI on that loan, which I'll get into in more depth in the next webinar. But the interest paid on that $250,000 amount is $17,700. Scenario B there, with MARTA doing 3% down, the interest paid on that is $15,379. So it's $2,400 difference in interest. So it does definitely benefit you to put money down if you can. So miscellaneous cost to plan for a credit report, you're going to pay for that, which is $75 to $125. You do want to get a home inspection on a home to make sure, if there's any repairs that need to be done, you can get those taken care of, with the seller and potentially have the seller pay for them before you own the house, or you can negotiate the price down. So I always recommend a home inspection if possible. And then appraisal cost, we will do an appraisal to make sure the value of the house is supported for what you're buying it for. And then you have real estate taxes, which are the property taxes, repair costs, and ongoing cost with maintenance of the house. I got 2 more slides here. So the home buying costs, the biggest thing are the closing costs, which I covered in the last slide. I would, rather than go through each of these, just, you want to plan on 2 to 4% of the purchase price that you're going to have for closing costs. So that's for your escrow setup for taxes and insurance, and then the hard cost of the loan. You want to plan on 2 to 4% of the purchase price. So that's on top of what your down payment is. Sometimes you can get the seller to pay that for you, depending on how competitive it is. And your realtor will be able to guide you better on that, if there's a lot of offers coming in or not. But sometimes you can get the seller to do a seller concession or a seller credit, it's called, where they cover your cost. That way you only have to worry about coming up with a down payment. So just something to keep in mind to talk to your realtor or lender about when you're going to buy a house. And then just want to cover PMI real quick. Anytime you do less than 20% down on a home with conventional loans, FHA loans, you're going to have PMI, private mortgage insurance. So PMI is a monthly amount that you pay each month. And then once you get to 80% of equity in the house, eventually that PMI will fall off. So that's not something with conventional that's going to be on there for the whole term of the loan, the full 30 years or 20 years or 15 years. It's just on there until you can get to that 20% equity position. So if your house appreciates, a substantial amount in a couple of years after buying it, or if you do a bunch of home updates to it to increase the value, then you want to look at, can you get that PMI off there? PMI costs generally range from $30 to $70 per month each $100,000 that you borrow. One thing to note on FHA is that the PMI on those loans, those are on for the life of the loan as opposed to conventional. So that's why conventional is definitely the best route to go if you can. And then, sorry, Rustin, I had a lot of time here, but had a lot of information to cover. But I'm going to go and pass it over to Rustin here, and then I can answer any questions at the end if we have some additional time here. You can stop sharing.
Thanks, Greg. Appreciate it. Lots of great information. I actually was a loan officer and in lending for 10 years before I became a real estate agent. And Greg's about as best as they come and explained it all really thoroughly. I know that there's a lot of questions for him, and I'll try not to take up too much time so he can hammer some of those out. But otherwise, always feel free to reach out to either one of us afterwards and get some specifics answered. I'm going to jump into a couple slides, and then we'll leave some questions here. Let me grab mine here. So I'm going to talk a little bit more about the actual home buying process. Hang on, there we go. Can you guys see my screen?
Yes, we can.
Yeah, I can see it.
You can. Okay. So this first slide, obviously Greg talked a lot about the mortgage process, and that's always step one. And you want to really make sure you're talking to a good loan officer with lots of experience that understands your whole entire process and your own unique situation. There's no two transactions for home buying that are the same. There's always something different one way or another. So just make sure that you're talking to somebody knowledgeable and that has a whole bunch of different programs, because there's so many good programs out there. And I know Consumers Credit Union has a ton of these programs, especially like the first time buyer programs. There's rural development programs if you're looking kind of out in the suburban areas. And there's grants that come along all the time. So obviously there's that. But when we get into the actual house hunting and working with a realtor, I wanted to talk more about that. So there's always two sides to every transaction. There's a seller and there's a buyer. And it's really important to have representation on either side of that, so you have somebody helping you and kind of holding your hand through the process. And then there's obviously going out and looking at houses, which is fun. It can be fun. It can be stressful. But that's one big part of it. But whenever you actually find the house, I always tell all my clients that's halftime. We're halfway through. We still have the second half to get to the closing table. So keep that in mind. And then we're going to jump into a couple of these actual specifics here. So when you go and you meet with a buyer's agent and talk a little bit about like, hey, what are we looking for? There's some things to consider. In one of them is obviously location. School district, it can be a huge part of where you're looking. Like if you go downtown Grand Rapids, like you're going to pay premiums with different school districts for sure. I can't say which ones, but you might be a block away and you might have a house that's worth X, and then if you go down the street, it might be worth 20% more just based off of which school district it's in. Amenities, things like that, that's all stuff to consider. Budget, I had it on my notes to talk a lot about this, but Greg covered it. The big thing is obviously you've got your closing costs and things like that, but also your payment, your monthly payment. And I think that it's super important that Greg touched on the tax difference. And I see it all the time in community like Facebook groups and things, and people are like, hey, I bought a house last year and the taxes have doubled, or my payment has gone up X amount. It's almost a double whammy when that happens, because normally if you're not putting 20% down, you have to escrow your taxes and insurance so that the mortgage company pays for those. And then what ends up happening is if you have a loan officer that doesn't know what they're doing or isn't setting proper expectations, you might see your tax bill go up 30 to 40%. Well, that creates two problems. Number one, the lender then has to account for the increase that upcoming year to make the next tax payment, but then you also have the shortage in your escrow account. So yeah, your taxes maybe went up, $300 a month, but all of a sudden that second year of homeownership, you're at $600 a month because you're making up that extra loss or shortage that you had in that escrow account. So Great job mentioning that, Greg. I think that that's super important. Always keep an eye on those things because if like let's say you're buying a house that is super dated, it was grandma's house or something like that. She's lived there for 50 years. You're going to see a massive increase in your taxes. So all good stuff there, Greg. Thanks for mentioning that. Um, Other things to consider, like home styles, and that's why I always encourage my clients to go look at, like to start off, we should just go look at 5 to 7 houses first day. We'll go through 2 stories, ranch style houses, bi-levels, tri-levels, quad levels, barn dominiums. I mean, you name it, they're out there. And you might go through one, and you might be like, absolutely not. I hate this style of house. For example, like a bi-level, there's lots of stairs, not a lot of storage, and those are all things to kind of consider as you're going through the house, and kind of knowing, these are really great houses for maybe a young family, and maybe this is a better house or setup for a retiree or something like that. Market trends, obviously, we're going to talk a little bit more about that here in a couple slides, but always kind of know. Um, which way the market's going. You have buyers markets and sellers markets, and that's kind of how we'll describe kind of what's going on in the market. Right now we're in a seller's market for at least our area, and so you've got a lot of extra buyers that aren't finding houses that they want to see because the inventory is low. So we'll talk about that. One thing I always talk to people about though is resale, and I think this one is worth mentioning, and a lot of people don't necessarily think about this, but I've had people come up to me and say, "Hey, I'm ready to buy my forever home." I say, "Great, awesome." Um, we find their forever home, and 2 years later, they get relocated for work or something like that, and they just have to move. And so, that house was their forever home, but it might not be everybody else's forever home. So something to think about is always resale. There's definitely houses that are going to be better or worse for resale. Number one, obviously, is location. Like think about not just school district and things like that, but if you're on a busy road, that's going to wipe out a ton of buyers. So if we're in a down market, if we're in a buyer's market, not every house sells right away. Right now, everything eventually sells and usually within a few months. But what does it look like if the market flips? And I think that's something to always consider. So when you're going through a house, always think resale. Like what are the bad things about this house that other buyers might consider in the future if I end up having to sell when the market's just completely the opposite? So like busy streets, what's it close to? Um, is there issues with the foundation? And yeah, maybe the foundation's been fixed, but if you have a buyer that finds out that there was foundation issues, yeah, it will probably sell right now, but in a buyer's market, that house is going to just sit and sit and sit because then people have tons of houses to choose from. So just always kind of consider that. Um, Talking about once your offer is accepted. So you go out, you look at houses and you say, man, I love this house. Let's write an offer on it. Great. So you write up an offer, you get it accepted, and then you have all these other steps that are going to happen. So get your offer accepted, you have to put down a deposit. Typically that deposit's 1%. Or somewhere in that area. You could make your offer look stronger by going higher than that. And that's something that your agent will kind of help guide you through. Inspections, I would never recommend waiving an inspection. That does happen in our market when you're in competitive situations. Usually, and this says 10 days, and that's great to have 10 days, but even in competitive situations, that number might get moved down to 3 to 5 days. And just know, like at least in our area and the way our contracts are written, during an inspection period, you can typically back out of your contract during that time period, and then you would get your deposit back. Now, obviously, every contract's different, and so just know that. But inspections are a great way to get familiar with the house. You should always attend your inspection. It's usually the 2 3 hour appointment, and probably when you looked at the house, you were only in there for 20 to 30 minutes. So being in the house for 2 3 hours with a really a well vetted inspector will go a long way. You'll know everything about the house, even like if a plug doesn't work, or if it's not grounded. Like I carry this with me. You probably can't see because it's yellow. But checking plugs, checking all this stuff. Looking at the ages of all the mechanicals, like the utilities, the furnace, the water heater, things like that. Once you're through with the inspection period, and everybody's like, pass, fail, did you pass inspection? Well, technically the buyer makes that decision if it passes inspection. It's not necessarily the inspector saying, no, this house doesn't pass inspection. It's the buyer that makes that decision if they're willing to live with those items that might be wrong with the house. But let's just say you're getting through inspections and you tell your agent, hey, we're good to move forward. Then typically what happens is the agent contacts the lender and says, hey, we're ready to order the appraisal. So think of it this way. The inspection is the buyer's protection and the appraisal is the lender's protection. The lender is going to hire an appraiser. They're going to go out to the house. They're going to spend about 20 to 30 minutes. They're going to do some measurements. And then they're going to look for any safety or structural issues. On certain loan types, they'll look for other things like chip paint, tripping hazards, handrails, things like that. And so what that is doing is it's ensuring that the lender has a good piece of collateral to lend on. And then they're going to assign a value to it. And they're going to say, yeah, we think this house is worth, whatever you guys have a contract on. Or maybe it comes in low. And then what happens at that point? Well, then you might have to go into renegotiation mode. So a lot of different ways that can go. Number 5, Gregg talked a little bit about this. Loan gets underwritten. They're going to probably double check your credit and then they'll do verification of employment and all that before closing. So just keep that in mind. Don't change jobs or something in the middle of the process because that can create major issues. And then closing, you sign at a title company. The title company makes sure that you're getting the house free and clear of any other liens or anything like that. And then possession, this one's kind of an odd one in our area in West Michigan, and this is not normal for the rest of the country necessarily. But if you're going to buy a house and it's actually lived in and there's somebody possessing the home, then a lot of sellers in our area typically ask for time after closing to live in the property. So you might close on your house, but you might not get the keys for another 30 days. So another thing to keep in mind when you're thinking timelines, people come to me and say, hey, I got to be in a house by the end of the year. Well, then we should already have something under contract because it's going to take 30 days to close with the lender. And then you might have another 30 days until you can even get into the house. So again, every transaction is very different. So keep that in mind. I would highly recommend having a realtor that is knowledgeable, has experience, or at least if they're newer, has a mentor. That's what I did when I started off. It was super helpful. Last thing, kind of housing market. So things to kind of consider: market conditions. I already mentioned, is it a buyer's market or is it a seller's market? When we're in the spring, our area is very seasonal. And if you're not in our area, maybe it's not. Again, something to talk to your agent about. But like right now, we're heading into the winter months. In the winter months, we almost become more of a buyer's market where we've got a lot more inventory to choose from. Like you'll see right here, our homes currently for sale is 1344. That's probably about going to be our high mark. We usually hit our high mark in October, so I'm anticipating we're going to be about 14 to 1500, and then all winter long we're going to just drop on that, and so we usually hit our low point in March or April, depending on the weather around here, and then we'll start gaining inventory again. But what ends up happening, if we're talking supply and demand, at least in our area, our supply is really low in those winter months, those late winter months, and then we start climbing. But what ends up happening is we have a huge a demand surge near like the middle of February, kind of end of February, because people get their tax returns and they have money to spend and they want to go buy a house. So it kind of makes for the hot spring market. You'll hear that all the time. Oh, the spring market, it's crazy. And it is, because you have this huge demand surge and we have our supply at our yearly low. And so I would anticipate our homes for sale in March or April, when we bottom out, will probably be closer to about 800 houses. That's what it's been the last few years. So there's some other stats here. Obviously, interest rates do make an impact on what the market's doing. If the, obviously if rates are up, then affordability is down, and that might kind of, I'd say it would plateau home appreciation. So these are all kind of things to consider. Other than that, I think that's about all I got. I kind of talked fast, so sorry about that.
Thank you so much, Rustin. And thank you, Greg, as well. There's so much great information here for our alums. I know as Rustin was speaking, Greg was answering lots of questions in the chat. So thank you for that. Yeah, appreciate you sharing your time and expertise. In the interest of time, I am going to go ahead and wrap up for today, but please feel free to connect with either Rustin or Greg with any of your questions. I know that they'd be happy to follow up with you individually. We'll be sharing their contact information in our follow-up email, as well as a recording of this presentation. So please look out for that within the next week. And then join us again, 12 p.m. Tuesday, November 5th. Rustin and Greg will be back for a presentation on mortgages. So if you have more information you need from them, please don't hesitate to sign up for that program. And hopefully we'll see you then. Thank you, everyone.
Thank you.
Good, everyone.
Thank
Rest
you.
of your week.